What monetary policy tools matter beyond interest rates? Have you ever wondered what happens when interest rates are already low and central banks need to stimulate the economy? There are several monetary policy tools that come into play beyond just adjusting interest rates. Let's break these down in a simple way. First, we have quantitative easing. This is when central banks buy longer-term government bonds and other securities. The goal here is to increase the money supply and lower long-term interest rates. By doing this, borrowing becomes cheaper, which encourages businesses and consumers to invest and spend. This tool is especially useful during tough economic times when lowering short-term rates isn't an option. Next up is forward guidance. This is a communication strategy where central banks share information about their future monetary policy plans. By doing this, they help shape market expectations. When people know what to expect, they can make better financial decisions today. This helps reinforce the effects of current policies. Another important tool is interest on reserve balances. Central banks pay interest on the reserves that commercial banks hold with them. By changing this rate, central banks can influence how much banks are willing to lend. This affects short-term interest rates and overall liquidity in the economy. This tool has gained importance as monetary policy has evolved. Central bank lending operations are also key. These operations allow central banks to provide liquidity directly to financial institutions, especially during stressful times. By ensuring that banks have enough cash, these operations help stabilize financial markets and support the broader economy. Lastly, we have macroprudential measures. While not strictly monetary policy, these measures help maintain financial stability. They include rules like capital requirements for banks and limits on how much people can borrow. By adjusting these rules, central banks can influence credit growth and help prevent economic bubbles. In summary, while adjusting interest rates is a primary tool for central banks, they have a range of other strategies to influence the economy. These tools help address the limits of traditional policies and support overall economic health. Understanding these can help us interpret interest rate decisions and their broader impact on economic policy.